Welcome to The Explainer. Today, we're diving into a crucial set of rules from the Reserve Bank of India. Now, these aren't just some dry technical guidelines. They are, quite literally, the financial safety net designed to keep our entire banking system stable and secure.
So what we're zeroing in on is this, the RBI's Framework for Liquidity Risk Management. This was put together by India's central bank, and it's built on some really tough lessons learned from global financial crises. The whole point is to make sure our banks are ready for pretty much anything.
To really get why these rules are so critical, we have to start with this very simple but also very serious question. Because when a bank can't pay its bills, it's not just a problem for that one bank. It can send shockwaves through the entire economy.
Okay, so it all boils down to these two key ideas. Liquidity is just a bank having enough ready cash to meet all its obligations without causing a panic. And liquidity risk? Well, that's the nightmare scenario, the very real danger of running out of that cash, which could threaten the bank's survival.
And this risk, it's not one size fits all. It actually has two different faces. You've got funding risk, that's an internal problem where the bank just doesn't have the cash for its daily needs. Then you have market risk, an external problem where the market is in chaos and you can't sell your assets for what they're worth. And let me tell you, both are incredibly dangerous.
So, here's how we're going to break it all down today. First, we'll look at why banks need a plan in the first place. Then we'll get into the governance, who's in charge. After that, the toolkit they use, how they prepare for a crisis. And finally, we'll wrap it all up with why this is the ultimate safety net for everyone.
All right, let's get into it. The need for these really robust rules became painfully obvious after the 2008 global financial crisis. That was an event that really shook the entire world's banking system to its core.
You see, that crisis exposed some massive weaknesses. A lot of banks were caught with way too few high-quality assets they could sell easily. They were funding risky long-term investments with shaky short-term money. And maybe worst of all, most of them had no real meaningful plan B for when things went south.
So, to stop that from happening again, you need a solid foundation. You need to start with a really clear structure of who is responsible for what. And that's exactly what these RBI guidelines lay out.
The RBI creates this incredibly clear chain of command. It's not just a suggestion, it's a blueprint for accountability. It starts at the very top with the board of directors who set the whole strategy. Then you have the risk committee keeping an eye on things, and the asset liability committee, or ALCO, that handles the day-to-day stuff, all backed up by a data team. Every single level has a job to do.
And the guidelines are crystal clear on this. The ultimate responsibility lies with the board of directors. They have to set the tone, they have to approve the strategy, and they have to review it every single year. The buck absolutely stops with them.
Okay, so let's talk about the toolkit. It's great to have a plan, but how do you actually measure if a bank is healthy? Well, turns out there are two main ways they do it.
Think about it like this. The flow approach is kind of like watching a movie of the bank's money, forecasting the cash coming in and going out over time. The stock approach, on the other hand, is more like taking a quick photo, using key ratios to give you a snapshot of the bank's health at one specific moment. You really need both.
So let's see that stock approach in action. These ratios might look technical, but they're really just answering some critical, common-sense questions. Questions like, hey, how much of this bank is funded by stable, everyday customers? Or, does the bank have enough cash-like stuff to cover its most unreliable funding? Getting the answers to these wrong is a classic recipe for disaster.
All right, now we get to what I think is the most intense part of this whole framework, preparing for the absolute worst-case scenario. This is basically the banking world's version of a financial fire drill.
At the very heart of this is something called stress testing, and the goal isn't to predict the future. It's to see if a bank can survive what the RBI calls a severe but plausible crisis. It's about testing a bank's ability to take a punch on a really, really bad day.
And they have to test for all kinds of trouble. What happens if there's a problem that's unique to their bank? What if the entire market just melts down? And then, the ultimate test, what if both of those things happen at the exact same time? A bank has to prove it can handle all of it.
Now, these stress tests, they are not just some academic exercise. The results are used to build one of the most important documents a bank has, its Contingency Funding Plan, or CFP. This is the bank's detailed, step-by-step emergency action plan.
A CFP is what turns the abstract idea of a crisis plan into a concrete, ready-to-go playbook. It spells out exactly what to do, who has the power to do it, and how to make tough calls when every second counts. And just like a fire drill, you have to test it over and over again to make sure it actually works.
So we've gone through the rules, the roles, the drills. Let's just zoom out for a second and look at the big picture here. What's the ultimate point of this whole framework? It really all comes back to this one single, powerful principle. The main responsibility for staying safe and sound lies with the bank itself. The RBI sets the rules of the game, but each and every bank has to own its risk management.
Honestly, a great way to think about this whole thing is as the immune system for our country's entire banking sector. It's designed to make each bank individually stronger so that a problem in one place doesn't spread and infect the whole system.
Because at the end of the day, this isn't just about protecting banks, it's about protecting us, the depositors. It's about maintaining the kind of financial stability that our businesses and our whole economy need to function and grow.
And that brings us to our final thought. This entire framework was built on lessons from the past, but as we rocket into a future of instant payments and 24/7 digital finance, what new kinds of liquidity risks are just over the horizon, and how will the rules have to change to meet them?